Hi everyone, welcome to this edition of Kuvera Insights. My name is Neelabh, and as always, we talk to industry participants and bring their insights to you. We are discussing a category of mutual fund schemes today, known as Flexicap schemes. Joining us for this discussion is Vaibhav Shah from Mire Asset Mutual Fund. By way of a quick background, Vaibhav heads business development, strategy, and international business for Mire Asset Mutual Fund in India. He has almost 18 years of experience, of which 11 years have been with Mire Asset Mutual Fund. Before joining Mire in 2011, he has worked with DBS, ICICI Bank, and Carvi. By qualification, Vaibhav is an MBA in finance from KJ Somaya Institute, Mumbai. Welcome, Vaibhav.
Thanks, Neelabh, and thanks, Kuvera team, for this opportunity.
Great. So, quickly jumping into the topic, Vaibhav, could you help us understand at a very high level some of the different categories of funds based on the SEBI categorization?
So, thanks, Neelabh. So, as per the SEBI guidelines, so we've defined categories into different categories. So, first, you've got equity schemes, you've got debt schemes, hybrid schemes, solution-oriented schemes, which is for retirement and children education, and you've got other schemes where index funds, ETFs, and fund of funds are classified. So let me start with the equity category. And within equities, you could classify funds based on market caps. So the various categories which are present based on market caps are, you've got large cap category. In large cap, you can invest at least 80% has to be invested in large cap stocks. Then you've got the next category, which is the large and mid cap category. In this category, we invest 35% in large cap stocks and 35% in mid cap stocks. The third category is the mid cap category, where at least 65% has to be invested in mid cap stocks. Then you've got the small cap category, where 65% is invested in small cap stocks. And then you've got two very interesting categories, which is the flexi cap and the multi cap category. In the multi cap category, at least 25% is invested in large, mid, and small cap stocks, respectively. While Flexicap is a very interesting category, which only states that at least 65% has to be invested in equity and equity related instruments. However, it doesn't define how much has to be allocated in large, mid, and small. So, as the name suggests, there is complete flexibility of investing across market caps. Since we've mentioned a lot of words as large, mid, and small, let me help define what is classified as large cap stocks, mid cap stocks, and small cap stocks. So the top 100 companies by market capitalization are classified as large cap stocks. Companies which have market capitalization between 101 to 250 are defined as mid cap stocks, and companies which have a market cap from 251 to 500 are classified as small cap stocks. So essentially, these are the key categories, market cap categories within the equity mutual fund category that investors look at investing. And like all of you would understand, equity is one of the most preferred asset class for investors when they want to look at long-term wealth creation as an investment tool. So some of these are very important categories that investors can look at. There are many categories, like value, contra, ELSS, tax saving, sector thematic funds as well. Maybe I'll not go too much in detail, but there's a wide variety of funds which are allowed within the equity category as well.
Got it. Thank you very much, Vaibhav. And just to add to what Vaibhav said, similarly on the debt side also, for different segments, different maturities, there are different um, categories of mutual funds. So it ranges from long-term debt mutual funds to very short-term, like overnight funds. Um, Needless to say, these are, for both equity and debt, different categorization is meant to define what kind of investors should be looking at investing in these funds based on their investment horizon, their financial goals, and how much actually are they planning to invest. Uh, so just to bring more context to this, could you help us understand what a little bit more about flexi cap funds and how do they work from what you defined it seems like, and correct me if I'm wrong, on the equity side, they could invest in any set of any set of stocks from the top 1 to number 500 stock by market capitalization. Uh, Similarly, so could you help us, just understand this? How do these funds actually work?
Yeah, nowadays, actually, wherever you go, you would hear that the importance of flexibility is very, very high. So all of us need agility and flexibility in our life, and that's where FlexiCap is becoming a very, very important category for investors. So all of us understand that life throws out different opportunities, and it is very important to be flexible to take advantage of this opportunity. The unique part of FlexiCap category is that it allows you the flexibility of investing across market caps and across sectors as well. So let me tell you some of the key advantages of the FlexiCap category. So one is the portfolio stability. So in the case of a FlexiCap category, you get exposure to large cap companies in India. Now, essentially, large companies are the top 100 companies in India. These are well established businesses which have gone through multiple business cycles and have created a credible track record across various business cycles. Usually, large caps have stable earnings, strong growth potential, and they can help create support or downside, especially when markets are volatile. We have seen in the current market situation, markets have become quite volatile. In such situations, you typically would see large cap stocks to do much better than mid and small cap. Second is, you know, the growth potential. See, India is a market where there are about more than 7,000 companies which are listed, and India is a country of entrepreneurs. So you would also want to benefit from the growth potential of many mid and small caps, which would eventually become large caps. Look at some of the large businesses in India. They would have been mid and small caps when they started their business. Look at the largest IT firm in India. It started in the 1990s as a small IT firm and has now become one of the largest IT firms in the world. Or you could see one of the largest private banks in India when they started in the 1990s again, was a small private bank, and now it is one of the largest private banks in the world. So many of these companies, when they start, they are mid or small cap in nature, but because they continue to show the strong growth trajectory, they become eventually large cap stocks. So the advantage of Flexi Cap fund gives you is that it helps you identify some of these growth stocks and lets you hold them for fairly long period of time. I want to highlight, Neelabh, one key advantage that a Flexi Cap fund has vis-a-vis other categories. So, when we discussed is what is large cap, mid cap, and small caps, you would have heard the definition as what is a market cap they have to invest in. Now, what happens is in case there is a mid cap stock or a small cap stock which becomes a large cap stock, typically after a period, fund managers are forced to sell those stocks because you have to have a certain allocation to mid and small caps within the category as defined by SEBI. Hence, there is a tendency to actually sell winners rather than holding on to winners. And that's where FlexiCap is a category where significant advantages are there. We've done a study which shows that over the last 10 years, there have been 25 mid caps which have become from mid caps to large caps, and 5 companies which from small caps became large caps. So clearly highlighting that if you are able to identify good businesses, hold them for fairly long period of time, your compounding is immense. And one of the wonders of investing world is, like people say, compounding is the eighth wonder of the world. Hence, I think that's a key advantage of holding on to winners in FlexiCap, which I think so some of the other categories don't have. Third is the dynamic nature of FlexiCap. What happens in a FlexiCap is that based on market situations, you could keep changing your allocation to large, mid, and small. So there are times when markets are volatile, you would try and increase your allocation to large caps to bring more stability to your portfolio. And there are times when growth is very strong. At that time, you would want to increase allocation to mid and small cap. to try and take advantage of the positive market sentiments. So this dynamic allocation you can completely do in the Flexicap, which is again one key advantage this category has. And how do they work? They let you allocate between large, mid, and small cap stocks without any bias, uh, without any defined limits, and also lets you have the flexibility of investing across sectors. So essentially, what is happening is when investors start their investment journey, and there are investors who want to start investing in equity funds. Uh, Nowadays, an investor who wants to say have only one equity fund to start his investment journey. Earlier, investors used to start allocation in large cap stocks. Now they are very happy to start this allocation in flexi cap funds because in one fund, you're able to get the entire participation of large, mid, and small. So it is becoming sort of a fund which is one fund can give you flavor of all Indian market stocks.
Right. So I think in your closing of the last question, you mentioned that, or what I at least took away from it, that this is a category of fund which could be considered by a new investor, somebody who's not invested in mutual funds before.
Sure. So, a good point you mentioned, Neelabh, and actually when you started on the categorization, very important thing you mentioned is that there are so many categories, different types of mutual funds. Choosing the one which is best suited for you will require first to an investor to clearly define what is his investment need, to clearly define his investment goal. We've been a very strong proponent of goal-based investing, is that investors should, when they make an investment, clearly define the goal that they want to invest in. Because once you put a goal in mind, your investments are, you tend to become from a return chaser to a goal chaser, and your entire investment journey changes. So first is we have to define what is a goal. Now, if your goal is wealth creation, right, then equity is definitely a preferred asset class that you would like to look at investing in. If there are investors who have a moderate risk profile, then we believe that they should have a good mix of debt and equity, and that's where hybrid funds are best situated for investors. So within equity, like I was mentioning, Flexicap becomes an important category where investors can start their journey. Now, what we would suggest to investors is that when you start allocation to equities, you should have few things in mind. One is when you invest in equities, your time frame has to be at least 3 to 5 years. And especially when you invest in a flexi-cap category, because it gives you participation of large, mid, and small businesses, your time frame has to be slightly longer. It has to be at least 5 to 7 years. So one very important thing is that you have to have a time horizon of 5 to 7 years. Second is you should try and invest systematically. I know all of us have understood the importance of investing systematically to take advantage of all corrections in market. SIP has become one of the best tools of investing where, because of rupee cost averaging, you are able to take advantage of all corrections. So similarly, even in a flexi cap fund, I believe if investors were to use SIP route and to invest with a 5 to 7 year time frame, it is actually becoming one of the go-to categories where you get the flavor of all large, mid, small businesses in India and the ability to grow them for a fairly long period of time. See, one important thing, Neelabh, that I want to share is that there is a lot of question that is there enough juice in large cap stocks in India? And when you actually see the large cap companies in India, the large cap companies in India are actually mid and small cap in global context. So the largest company in India is not even 10% of the largest company globally. So that tells you that because of the demographic profile of India, where your average age is 27 years, you have a population of 140 crore people, and a labor force which would be there for maybe the next 2 years, India will have the highest working population in the world. You would have the best demographics across all the economies in the world. And I wouldn't be surprised if some of the largest FMCG companies, banks, or many consumer companies are actually Indian companies after a decade or more. So large cap companies will continue to do very well. However, the growth potential, like we discussed, also happens when you are able to identify mid and small cap companies early. So in the flexi cap, you've got all the three flavors of stability of large and the alpha generation or growth potential of mid and small. So we believe that it's a good category that investors can look at while allocating their investments.
Right. Right. I think one to add another element to what you said, Vaibhav, is that it helps you approach the risk of investing in equities in a more balanced way, perhaps, than focusing purely on a small cap category or purely on the mid cap category, where risks generally tend to be on the higher side. Uh, and this is just for the equity side. Similarly, by having an exposure to debt, which is variable depending on how market movements are interpreted by the fund manager, a flexi cap fund can sort of work for you across different markets. Great. So that was very helpful. Now, just changing track for this next question. On a practical side, how are these flexi cap funds taxed? Because debt funds are typically taxed where the tax horizon for long-term capital gains is 3 years. Equity funds have a long-term capital gain tax horizon of 1 year. What is defined as long-term is because long-term is different, and here the scheme category itself allows for the variation to move from 65% to higher. Does that mean it keeps shifting from equity and debt?
So Neelabh, good question. Actually, what happens is, like we mentioned, like you rightly mentioned, the allocation to equities is more than 65% at all periods of time. Hence, your taxation will be equities. So if your holding period is more than 1 year, then you are taxed as long-term capital gains at 10%. And if your holding period is less than 1 year, it is short-term capital gains and taxed at 15%. One key advantage that Neelabh, you also brought out was when you look at investing and you have a separate large cap fund, you have a separate mid cap fund, and you have a separate small cap fund. And you would have different entry and exit points for each of these funds. Uh, there could be a different tax element. However, in a flexi cap fund, you are able to get the flavor of large, mid, and small cap within the same fund, right? So if your holding period in the fund remains more than a year, then it is long term and taxed at 10%. Why the fund manager has complete flexibility to be even much higher in mid caps or large caps based on market views. So typically a fund manager can keep 60-70% allocation to mid and small caps when the markets are very bullish, and can actually reduce the allocation to as low as maybe 10-20% to mid and small caps when he wants more stability of large caps. So within the same structure, taxation remains very efficient, and investors can actually reallocate money between large, mid, small within the same fund without necessarily owning too many funds. So that again is a key advantage that flexi cap funds provide to investors.
Right. So on to my last question, Vaibhav. How do flexi-cap funds react to market movements? And is there a right time to invest in this category?
So, good point in the lab that you mentioned. So actually, let's look at current market situation. India was actually one of the best performing markets in 2022. But as we start 2023, we are one of the worst performing markets in 2020. So from being the best performing markets to the worst performing, at least in the first quarter of this year, a lot of questions will come in investors' mind is how should they invest? So let me give a very brief of where we are in markets and give a sense of where we feel markets are. So we are in a situation where, interest rates, we are maybe somewhere near the peak globally as well as in India. Maybe we might see one or two more rate hikes from the Reserve Bank of India, but we are somewhere near to the peak when it looks at interest rates. India continues to remain one of the fastest growing economies in the world. If you see IMF or World Bank or any other forecast, it clearly highlights that India is one of the fastest growing economies. And over the next 10 years, India will become from the fifth largest economy to the third largest economy. So the growth will continue to be quite robust in India. Next is the Nifty earnings are expected to be quite robust over the next 2, 3 years. So we're still expecting sort of late teen returns from earning side for Nifty companies. In that sense, we believe that the outlook for markets is quite constructive. And hence, investors with a 3 to 5 year perspective can be richly rewarded when they invest in a very systematic, staggered manner. Now, what happens is, if you were to look at markets, market never works in a straight line. They actually go through periods of bouts of huge outperformance and periods of a lot of pessimism. And there have been times when mid and small cap valuations have gone up considerably and have also corrected significantly. So sometime last year we saw that mid and small cap had become at significant premium to large caps. And in this correction that we've seen, both in time and price correction, now mid and small cap valuations are somewhere closer to large cap stocks. So in this current market situation, we believe uh, you can have allocation across large, mid, and small, and get the advantage of investing for fairly long period of time. So like I mentioned, if you invest over a 5 year perspective, we believe there are decent returns to be made in markets. Current valuations are also suggesting that you could increase allocation to mid and small caps. And the flexibility is completely with the fund managers. If you were to see a further correction in markets, you could actually increase your allocation to mid and small caps as well. Again, another large flexibility with these funds is they have the flexibility of changing allocation to various sectors. So last year we saw in 2021 the best performing sector was IT, and one of the bad performing poor sectors was banking. But when you look at 2022, the best performing sector was BFSI or banking and financial services, and the worst performing sector was IT. The Flexicap fund, you have the agility and flexibility to move sectors as well. And that's where, based on market, we believe we are currently in a situation where investors, if they take a 3, 5 year plus window, they can get advantage of all three segments. And there is enough flexibility to invest uh, across sectors to get, decent return potential. So we believe that in the current situation, where like I mentioned, interest rates will continue to be choppy. Global growth will be quite choppy, though India will continue to do well. We believe a fund which has flexibility to be across all these segments, across sectors, will be better suited rather than owning a separate mid cap fund or a small cap fund or a large cap fund. We believe that it's a good time to have maybe a flexi cap sort of a strategy as part of your portfolio, where you could change it dynamically based on market valuations.
That was a fantastic explanation, Vaibhav, and thank you so much for taking the time today to be with us. Just to very quickly, summarize in 2 or 3 lines what we spoke about today. So FlexiCap funds effectively are a category of mutual fund schemes where the minimum investment needs to be 65% in equity instruments, irrespective of which segment, as long as they are in the top 1 to 500 uh, equity.
Yeah, they can invest across market caps. Right.
Right. So that is one. The second thing is from a taxation standpoint, because the threshold is minimum threshold of equity is 65%. These will always be taxed as equity. So the long term, from an LTCG perspective, long term capital gain perspective, you have to stay invested for more than 1 year, which is very good as compared to non-equity category where you need to be invested for more than 3 years.
Okay.
And therefore enjoy lower tax implication. The third point, and I think which is also very relevant and a key takeaway for the audience today, is that the embedded flexibility in the structure of the fund allows investors to hold fewer funds, which are probably which is probably easier for them to understand also. And because of the embedded flexibility, the fund is able to, and by the fund I mean the fund manager, is also able to react appropriately to ups and downs in the market, and take some of that load or decision making which would probably fall on the investor or on the investor's advisor, where they would choose one large cap, one mid cap, one small cap, one debt fund. With that, we conclude. Weber, we will come back to you if we have any questions from our audience and who would like to know your responses to the same. But outside of that, thank you very much, Weber, once again. And we hope this was as insightful for the audience as it was for me, you and I.
Thanks, Neelabh, and happy investing to everyone.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully.